Hello and welcome to another edition of Deal Hunter. I am your co-host, Mitch, Flax, founder and CEO of Net Equity Capital. It's good to be here. I've got some friends per usual. My homeboy, Tom Staub. It's good to have you in the studio. You look like you're finally back in Austin after traveling quite a bit.
Well, we just picked up, so we've been out in Arizona for some time, Flagstaff, and we just decided that ripe conditions to expand. We're now picked up 23 acres for 100 lots out in Prescott. So that's our newest little sub-market, if you will.
Congratulations. Well, I'm happy to have you back. I always love seeing you in your polished studio. I've got to get a good setup like that. And we've also got a guest that we've had on here before, Rob Anderson, president of BV Capital. Rob, how are you?
I'm good. Appreciate the chance.
It's always great to have you. We've gone back many years now, and both have pivoted into real estate from the financial services industry. And I just love what you guys are building over at BV Capital. I think you guys are one of the better sponsors out there who are essentially, democratizing private equity real estate for the individual investor. And you guys really are exceptional outfits. And I think you bring a lot to the table from an investor perspective. So good to have you, man. Thank you.
Mitch. Thank you.
So guys, today what we wanted to really focus on was looking at headwinds and tailwinds, both in the real estate space, and ways that BV Capital is positioning themselves, as well as areas for investors to really focus on. Certainly, the economy is dynamic. We're seeing a rise in interest rates, and certain sectors may be overvalued or frothy. I personally think there's opportunities elsewhere. It's more deal by deal versus kind of a macro approach. But we've got Rob on here from BV Capital, and I'd love to hear kind of what BV Capital is up to these days from, really what's a big focus for you guys, and maybe some areas that aren't a big focus for you.
Sure. We are still very heavily centric on Texas. We've seen a lot of deals around the country, and it's just real estate's location, right? Texas still has so much going for it right now. And we find ourselves all over the state. Now, as far as obviously the headwinds are simple. It's inflation and it's short-term rates, right? The 10 years pushing 2 right now. So your financing is something you really got to figure out, and you got to have smart financing right now. We don't think that's a long-term situation. Is the Fed going to raise rates? Yeah, they have to. They're kind of slow to do anything in the past. Probably got 50 bips coming up, maybe another quarter or two. I don't think they're going to go as heavy as a lot of people think they're going to go. A lot of people have a whole point, maybe more built in. We are more of the opinion of at least 75, but they've got to go gradual, or they're going to have such a reaction, which they've always had in the past. And you're already starting to see the choppiness in the equity markets, right? So short-term rates are an issue when it comes to financing. So you got to have really smart financing. Long-term inflation's an issue. Tom and I were talking last time about ground-up development. Well, inflation is a huge issue with cost of materials, labor, lumber. Then you get the supply chain issues, which will eventually work themselves out, so we hope. So those are kind of the issues. If you can mitigate those issues, man, it's almost never been a better time. We are so underhoused in the United States, and especially in Texas, where you have population growth, that we are easily 5 years behind if we were full speed building, right? And, one of you guys mentioned earlier the issue with there's a lot of folks jumping into this market that may not know what they're doing. And for investors, that's going to be the biggest challenge they have, is figuring out if who they're working with actually knows what they're doing and has been there before. So kind of all over the map with you there, Mitch. I'm sorry, but those are, obviously you got to look at inflation. You got to look at short-term rates as far as how you're going to handle that. On the other side of it, it's really interesting. I wrote down some stats, so speaking of inflation, to counter inflation, you've got to be in asset classes that can grow your NOI. If you can't grow your NOI, you're not going to keep pace with inflation. And what does that mean? That means multifamily. Multifamily is the absolute number one best asset class to compete with inflation, because you can grow really quickly with it. You'll be okay with triple net, but a lot of these other properties where you cannot raise your rates, or you're responsible for the maintenance, and therefore you have the inflationary effect on the cost of that maintenance, that's going to be an issue as well. So some things you got to think of there.
Yeah, Mitch, let me say a few things, right? So It costs about $2,000 to build a website in an LLC filing. And it takes pretty much a few phone calls to go get some capital to get a deal done. To Rob's point, operator experience and track record is really critical out there. And I'm talking to all of you smaller investors or retail investors and institutional investors. It's amazing how easy it is to get money. And you really got to make sure you're working with someone like Rob, who has a lot of experience. But to your point, I just had my team summarize Jared Horton earnings report for me. Listen to these 5 stats, right? Q1, 48% increase in earnings year over year, okay? Pre-tax income increased 45% year over year, okay? Revenue's up 20% year over year. They have 25,000 new starts, which is an increase of 35%, with only 1,000 homes unsold, okay? And then their home sales revenue increased on 17% per home, and they're selling roughly 19,000 homes annually. So D.R. Horton's kind of the bread and butter in terms of the market barometer, and they had a phenomenal earnings report. And I've been seeing this quarter after quarter, really strong numbers from Toll Brothers, Lennar, D.R. Horton. So if anyone's questioning the conditions of the market, it's still, to Rob's point, that demand-supply ratio is way out of whack. And it's amazing, the timing. If you can make it happen in your deals, it's a great time to be doing this.
So you guys brought up, cost of material, and Tom, I know you've obviously been focused on ground up development more on the horizontal side. And Rob, I've certainly seen a few deals come your way where you guys are focusing on some ground up development where traditionally you've bought existing, value add properties. Anything specific with regards to those headwinds that have changed BB Capital's strategy on potential investment opportunities?
No, not at all. Texas is so far underhoused, it will take us 5 to 10 years to catch up if we're able to. So if you can find land that has utilities, that's in a good market, full speed ahead. We've never had a bigger pipeline of things that we're chasing right now. With the population growth and the job growth and the lag, a lot of those stats that Tom's talking about is the lag of supply. So, if you have a good construction company or GC, or if you do it in-house like we do, and you can manage that, it's almost a home run, where buying existing assets is just too expensive nowadays. Yeah. The institutions have built them up. With the in-migration we're getting, you guys in Austin will appreciate this. I was listening to a guy talk last week, and he was talking about, California has the best highways in the country, and they all lead to Texas.
I love that.
So use that if you want, but it's true. And when you have this massive, we just can't keep up. The dynamics will not change anytime soon. So no, we are actively scouting land. Here's what we're doing, Mitch. A lot of the deals that we have when we build multifamily from the ground up, we're actually going back to the city and presenting changes to the PD to increase our density and raise the units. We just did one recently. We went from 330 to 400, and the city was like, great, do it, go. It was one of the easiest.
Hey, Rob.
Yeah.
Let me ask you. So I was in a Uber ride recently. It was in Dallas. I'm like, I was talking to the guy and I said, 185 people moved to Austin per day. He was like, 185? We got 500 here in Dallas. Right? So, it just goes to show, to your point, the migration patterns are, they're phenomenal for Texas. And in 2018, I did a conference with John Burns Consulting and talked about the migration patterns. And back then it was like, we know it was a smile state, so it's going to have all the migration, but it is, double, tripled those estimates from 18. It's amazing.
Here's another one I'll shift on you. You guys know I like industrial too. So yep. E-commerce is not stopping. Okay. Yep. So check this one out. So obviously the boom in industrial is driven by, consumers' demand to have goods shipped to your house within a day, right? So we are the reason for that. Every $1 billion in new e-commerce sales creates the need for another $1.2 billion in industrial space.
Oh, wow.
I'm gonna say that again, right? Every $1 billion in new e-commerce sales, and e-commerce sales has been like this, right? That creates the need for another $1.2 billion in new industrial space. And where do you build industrial space? Where the people are.
Yeah.
So Texas is exploding, not just in housing needs. And it's not just Texas. Tom, I think you're in Arizona. There's a lot of unique markets around the country that have this need, but single family home, multifamily housing, industrial. And here's one thing that'll surprise you. In certain markets, offices even starting to really pick up. In our particular office market where we are, there's zero vacancy. That shocks a lot of people. Now, it may be Dallas centric, but I'm pretty sure Austin's got similar issues. But it depends on where you are. Things have changed, and things are changing fast.
Yeah, it's funny. It's a quick little story, Mitch. Last year, I was trying to find a small office space, like 1,200 square feet, and I was like, oh, it's a great time, commercial crash. And so I go out there shopping, and I'm like, I see the vacancies, but no landlord's willing to give me a price break. And to your point, it's because it's all come back now, back to market, and it's all filled up.
Yeah, the majority quit paying their rent because they knew they'd have to send people back.
Yeah.
So we didn't get that bloodbath that we were so hoping. I think hotels were really about it. We're way overbuilt in retail. You're going to see a lot of repurposing of retail. A lot of retail, as they say, 2 to 3 times overbuilt. Now, there's good retail too. This is a misconception people, lose sight of. There's good retail, but a lot of the soft good retail is probably 2 to 3 times overbuilt. And so you're going to see a lot of repurposing there, which is going to be interesting to see how developers can pull that off.
Rob, let me ask you this. One of the things that you actually mentioned was instead of going out and purchasing those existing assets, to go out and actually ground up and build from scratch. Because I am hearing that, I'm seeing that it's something that Tom has been doing. I've been doing it from buying single family homes. I certainly think it's a lot easier to go out and buy something new than take an existing property and not knowing what you're getting into. So I just like, to having controlled costs. But on your level, on your scale and what you guys have been doing, because last year BB Capital had several investment opportunities to where you purchased existing assets. You did a working class C property for the Sierra Vista deal. You had the student housing portfolio, which I think was a newer building, but you probably still had some value add there, maybe some mismanagement opportunities. So there might be some opportunities like that. Is it correct to say that you're more interested in the ground up development because just the valuations just make more sense and you're willing to hold off on that preferred return for investors for perhaps a larger multiple?
Yeah, the market changed. And so, for 10 years, you would buy a B-, B+, A- property, renovate it, grow your NOI and sell it for a lot of money, and everybody loved it. And the beauty of that is you can make quarterly distributions to your investors along the way, and everybody loves getting that constant reinforcement that they made a good decision, right? The problem is, though you used to make ballpark 18 to 22% return figures on that as an investor, project level is probably a couple points higher. You can't do that anymore. Unless you go way out to tertiary markets, or if you're going to do workforce housing and you're going to deal with a C-class property, it's really, really hard. There's some nuggets out there, but it's really hard. Another thing that's happening, though, is the massive uptick in DST properties. So don't think that that's not changing anything. So I'm going to step back a little bit on you, Mitch. 20 years ago, it's been 20 years, believe it or not, Robert Kiyosaki came out with Rich Dad Poor Dad. And most people have all read that book, and they all went out and bought 1 million rental homes. Right? And now what we're seeing with the baby boomers getting to retirement age is they're selling all of these rental homes because they don't want the phone call in the middle of the night about a toilet breaking. And so they're moving from active to passive. By doing that, they're selling these rental houses and they're moving into their 1031 exchanging into a DST. DSTs, Delaware Statutory Trust, which is a fractional 1031. These are the funds that people are selling. They have 4 times the demand than they have supply. So what's happening is these larger shops are scooping up everything they can find because they know they're going to sell it in a DST in 3 days. You have this effect that's driving up the valuations of all of this. And so and this was new. This is just within the last, call it 3 or 4 years. It's been skyrocketing.
Well, Robin, that's why you're seeing, I was trying to buy a rental, a new one up in Killeen. Not a great market. It's a strong rental market for Fort Hood. List was $200,000, selling for $250,000, $260,000. In a pretty shoddy market and cash offers left and right. Now there's companies that are intermediaries helping that happen, but to your point, I think the DSTs are gobbling these properties up left and right.
They are, and there's single family rental DSTs, which is really unique, and it's a new thing. But on the multifamily side, they have bid everything up. So when people talk about the institutions coming into the market, that's where a lot of this is. And I know this because we have these DST sponsors calling us weekly, if not more often. You have product, you want to sell something, it's getting annoying. So kind of like when you get those text messages on your phone trying to get you to sell a house that you don't own, happens all the time.
Nancy Pelosi, leave me alone. I get a daily text from Nancy Pelosi. I'm like, what are you doing?
Well, and Blackstone just bought a huge company that does single family stuff. If you look at that, so you're going to see more and more of it because only 2% of single family rentals are institutionally owned. And the institutions see this and they're going to pour into this in a big way. I'm trying to remember your initial question there, Mitch, because we got a little off topic there, but I think it had to do with ground up. So we absolutely shifted to ground up because the returns are so much better. Now, as an investor, you don't get paid to the end, but when you get paid, you hit the lottery. It's kind of what it feels like. Because we're talking 2 to 3 times on your money. And here's the cool thing, it can be as quick as 3 years. Because depending on what kind of product you're building in the apartment space, if it's garden versus wrap means apartment garage wrapped with units, higher end density, but then you got a higher exit. Those take about 3.5 to 4 years, but a garden you can do in 2.5 to 3 years.
Yep.
And you can still have a 2 to 3x potentially on your exit. Find that elsewhere.
Yeah, and go back to the existing structures, right? You're at a 5% cap. You think about what a 10-year going to 3% means, right? Like your debt structure matters a lot more in these existing syndications than it does in it still matters.
Exactly, Tom. So Tom, a lot of folks we look at everybody's PPMs that are out there, and you got to watch. Remember, I said you got to watch the debt. A lot of these people are doing interest-only variable rates through construction or through renovation. What happens if the Fed does go to a point? How does that affect your model? Is that built in? Another trick that we see other people doing is they're betting on a refinance to cash people out early. And because an IRR is time weighted. So the sooner you give people the money back, the higher that IRR looks. It's a complete trick and it throws people off. I prefer the equity multiple. If I give you $1, what are you giving me back? Just if people are looking, trying to figure out what to do and how to understand this stuff, it's just a little kind of a cautionary thing. You got to look at that. If there's a refinance in that model, I'd probably step back and say, well, what if that refinance is not the way you think it is? How do the numbers look?
That's interesting that you say that, Rob. I'm glad you brought that up. There's so much gamesmanship that can be played around IRR. So I'd rather look at the MOIC, right? I think that's just a much better, paints a much better picture of what am I actually going to get back. And so that's an interesting point. I tend to agree with
Mitch,
you.
This RIA thing, for the layman, what does NOIC mean?
Multiple on invested cash.
Okay. Cool.
Capital. Yeah, you throw that out so fast, it sounds like Mickey Mouse or something. Like that.
That could be a new song. So so it is interesting too, because I'm building a few new single family homes, and we've got a real estate group to where we're building out a group here in Austin that helps new home buyers really kind of revalue how they're going to go out and purchase a new piece of property rather than going out and entering this market and getting into a situation where you've got 20 bids on some 30, 40-year-old asset. And we're trying to educate those retail folks just buying individual homes for themselves, saying, hey, you know what? Why don't you delay gratification a little bit and we can help you build a home instead. And you'll get something new. And by the way, when you actually look at the valuation there, you'll have built-in equity just off of that arbitrage of what the cost to build is and what the actual valuation is.
Especially in a market like Austin, like what would that ballpark savings be for somebody that you're doing that with?
It's a great question. So I just went under contract for a lot around the corner from my home. That same home, newly built, a 2,500 square foot modern farmhouse, not something that's kind of a spec house, but something a bit higher end. The market is valuing quality, by the way. It's not just if you build it, they will come. If you build it well, they will pay a premium. And I think that is important. And so buyers are being more cognizant than some of that. But the comps that I saw are roughly getting $650 to $800 a square foot in East Austin.
Yes.
So it's going to cost me approximately $650,000 to go out and build a high quality single family modern farmhouse, plus the acquisition costs of the land, which I just bought a piece of dirt for $600,000 on the east side, which is bananas. So all in, call it 1.3 million. but those comps at 700 to 800 a foot put this home from anywhere from 1.6 to 2 million. So you're talking about $300,000 to $500,000 in instant equity that I've been able to build as a new owner of that asset versus going out and purchasing something directly in the market. Now I've got to, there's obviously headaches that I've got to deal with. I just got a quote for a 2,500 square foot home for lumber for $82,000. I'm ready to rent a truck and drive up to Canada myself.
Hey, we actually shopped a mill. We want to buy a mill if you find one.
That's a great idea. I'm interested.
I don't know why those tariffs are not gone yet. Come on, Biden, let's go pick it up. Mitch, in the Austin market, and this is going to be obviously different depending on where you live, but square foot prices at retail are like $300 a square foot to $1,000. So it does range. Mitch's focus is on the very nice areas, luxury, if you will, around Austin. But I mean, still, $300 a square foot is what we're getting in like tertiary markets of Austin, if you will. So still robust. Even Dallas.
And actually, we're scouting 4 or 5 spots in the outskirts, like outside of Travis County.
Oh, are you? Where at?
We are. Well, that's another podcast. We've got.
Hey, buddy, this is like gang wars. This is my territory.
There's so much out there, but we're probably a little further than you want.
Okay.
I mean, with all the chip manufacturing plants and all the stuff that's coming to your greater area, it's not even just the city. I mean, you guys expanded so far that it's fascinating to see what's going on in Central Texas.
There's more coming.
Yeah, it's not going to stop.
Yeah.
So we looked at ground up, certainly now being more of interest than it was in the past. And so do we expect to see BV Capital focus more there than looking at some of the value add that we saw in 2021?
Oh, absolutely, by far. And in fact, if you look at what the land deals we did last year, they were all multifamily with one exception. We did a vacation home property on the coast. And that's just the boom in vacation homes due to COVID and everybody being able to work remote and, being able to work from a vacation home, those things have boomed. But for the most part, we are going to be a ground up multifamily shop predominantly, at least for the next few years. There's just way too much value creation that can be, given to not just us, but investors in general.
Are you also developing the land and going horizontal? Tom has really been virtuoso in that space and really kind of getting those builder ready. Are you going kind of soup to nuts, or are you looking for something that's already builder ready where you can go on there and start to execute?
It's really hard to find something builder ready.
I'm your man. Come on down to the party.
All right, well, maybe we should talk. I mean, most of the stuff is we're having to do drainage studies and we're having to, the pre-development work there's a fair amount of work there at the civil and just trying to get all that figured out.
It's one thing. So because I do primarily single family lots, most communities, 300-400 lots, and then we take about 20 acres for our own, whether it be garden style or 3-story apartments. Builder ready is really kind of for the single family builders. It's so customized to the builder owned apartments. It'd be hard to do a build ready. You can do all the utilities up to the property, which is what we do, but not like a pad ready sort of for multifamily.
Hey, if you're taking land and bringing utilities in, you're adding a ton of value.
Oh yeah.
And there is a ton of shops that would want to take that over, because if we can't get utilities to the site, we're just going to move on.
Yeah.
So there's probably a ton of capital and time that you've got to invest in order to get there. So that makes a lot of sense. Well, good. I'm glad there might be some potential synergy between you two.
Look at Mitch. Mitch is always making a deal.
Well, I'm just trying to connect people. Let me ask you this. This is something interesting, because a few weeks ago, I got on CrowdStreet's annual call-in for investment themes for 2022. And they were talking about their best places to invest and really kind of those themes. One of the things that I thought was interesting and is how they're democratizing private equity real estate to the individual investor. And I think one of the big misnomers about, some of those real estate platforms is that there's this fiduciary responsibility to the end investor to have these super high quality sponsors on the platform. And the reality is they're not liable. Like they're a platform. It's like, Charles Schwab offering a stock or a security. Yeah, they've done all the requirements to get it listed as a stock, but are they high quality? And I'm on there going through the group chat questions. And one of the things I found very interesting was that some of these sponsors who committed to having these quarterly calls were unreachable. And I just found that really, really interesting because they're almost kind of coming out and saying, hey, we've got this validation of great sponsors. Here's where I'm going. It feels like with all of these different platforms out there and private equity real estate becoming more democratized to the individual investor, how many bad deals are we going to start to see here? Now, folks have been bailed out. Rob mentioned this, where you're able to pay back these investors through refinancing. Well, guess what? That trade is over, okay? Because you're not going to refinance at a higher rate. Maybe you do because there's enough equity and meat on the bone to do that, but that's going to cut into the margins and make things more challenging. And there's something called beta creep, and that's when you start looking at riskier investments or riskier sponsors. Any insight from Tom or Rob on what we possibly could see and maybe investors need to kind of be wary about?
Yeah, I'll let Rob go first as our guest.
Well, I would actually say, Mitch, I applaud you for, being a registered investment advisor. You are actually holding yourself out as a fiduciary level to help somebody. And you've got your fancy MIT designation and all the other stuff that you've done from an education standpoint. This is one of those where people have kind of said, it's a do-it-yourselfer type thing. And if you're going to spend the time to do it, you can. But, we saw that with day trading too, how that turned out, right? So, I think we're seeing a shift right now. And it will happen when you have a massive shift from people going out of the stock market into alternatives such as real estate, which is happening right now. When the wirehouses, the Morgan Stanleys and the Merrill Lynches of the world start selling private real estate, which is happening today through shops like Capital and others, then you're seeing a wholesale shift. And when you're seeing that, every Tom, Dick, and Harry that wants to get in the business is going to get in the business, and you're going to have these issues that you're going to see. Tom kind of alluded to it earlier, and I fully agree with that. You're going to have a weed out period, and you don't want to be one of those people that got stuck in the weed out, right? And so I'm a big fan of somebody working with people that will help them navigate this space. The space is going to get a little bit more confusing the more people that jump in it.
Just add to that, Mitch and Robin. I'm always a fan of exposing the benefits of a variety of assets to the broad market. This is one of them, right? It's a really strong asset class to put your money into if you're with the right operator. At least this is my opinion, right? But again, the right operator. CrowdStreet is a platform. They collect money on transaction fees. I don't know their process of doing vetting of these operators. And my guess is they're on the platform because their cost of capital is 8-10%. Well, most equity that I'm getting is between 16 to 20% plus, right? My cost of debt ranges between 6 to 10%. So it's a way for me and others to get cheaper capital by the retail investor that doesn't know any better. And so they're already kind of targeting the more novice investor. Fine, they get exposure. But this goes back to my earlier point. When you have a frothy margin sort of segment of business, you're going to have a lot of sharks in the water. And those sharks might not be experienced, or they might be. And you have to do your own research with the helps of like the RAs, like Mitch of the world, to help you navigate that. And to Rob's point, doing it on your own is one thing, but really vet the operator and their track record.
That's perfect. That's exactly kind of what I wanted to hear. Thank you. I definitely saw a need for that. I don't know where that's going to go, and certainly kind of working on a few more letters after my name to kind of legitimize, bring that fiduciary standard, Rob, that we saw in our world on the publicly traded security side that really doesn't exist in this space yet. You're starting to see it. And I think it's going to become more important as we start to see that weed out period, as you mentioned. It won't hurt until it does. And when it does, it's going to burn a lot of people. And so, not just throwing anything that you see out there, getting back to CrowdStreet, one of the things I've had an opportunity, and I'm not bad mouthing them because I think they do a lot of great things, but one of the things that they're looking to do is build out that distribution to the RIA channel. And so as they create more relationships there, and they've got, this massive amount of supply, and now they've got the demand on the appetite for these RIAs and ultimately clients of RIAs, what happens when that supply and demand meet? Well, now they need more supply. And so ultimately, you're going to start seeing that beta creep. That's what concerns me for all of these different platforms out there. We're just going to start seeing deals that are more risky or just overvalued. And I don't know. I'm reading a book right now by Ray Dalio, Changing of the World Order. I highly recommend it. It really talks about how we've been printing money over the last 10 years. The amount of inflation that we've seen, people are like, oh yeah, well, it's only certain items. No, inflation's here, people. It's here. And for the folks that are building, Rob, Tom, myself included, anybody, you're seeing the cost of commodities. So how do you protect yourself from inflation? Well, it's investing in those assets, real assets that are great inflation hedges. And so I think, real estate is definitely one of those spaces. We talk about the stock market, yeah, but I don't know, man. Everything feels frothy to me. I don't know. I'm worried. I don't know if you guys have read that book or not, but I would recommend. I'd love to hear what you guys think about what that does.
I've heard a lot of good things about that book, actually. I haven't read it yet. I'd like to end on one key point here. If CrowdStreet goes to the RIA space, or, I mentioned our Capital, Case is another one, that there's a lot of people going into this space, right? There's a new one out there. Northern Trust actually is about to launch into the advisor space. So you're seeing more and more of this on the private deal side. But here's what people need to understand. It doesn't mean the RIA knows the business. There's a big difference. And Mitch, you and I saw this in our last career. You'll have people that are really good at stocks. You'll have people that are really good at options, or you'll have people that are really good at ABC, whatever it is. The same is true here in real estate. This is a very unique asset class. You have to find somebody who's going to help you navigate the real estate space. And that's why I was applauding you earlier for digging deep into this, because what is it? A jack of all trades, an expert in nothing, right? That is a very true thing. And there's value in how you can have a real estate advisor help you dig deep and understand this space for that piece of your wealth. Because this is going to become part of your asset allocation. If you just look at the numbers, it's happening in a large fashion across the country. You've got to find somebody, unless you are skilled enough to do this yourself, you've got to find somebody where this is a specialty for them. And that's a problem, because these due diligence officers have readily admitted that their teams, because I go listen to these kind of things, are not equipped.
Let me ask you this as we wrap up here. What can investors expect from BV Capital in 2022? Tell us a few things without going into full detail, but give us some ideas of some of the up and coming opportunities you guys have.
Yeah, I appreciate that. We're going to have a lot of development, a lot of multifamily. To Tom's point, we've even toyed with looking at infrastructure funding for suburban neighborhoods. If you look at the macro trends, we've got to get housing, right? We still love industrial, and we're actually going to build an office building, believe it or not, because of that zero vacancy I talked about. So vacation home is still an interesting spot. Anywhere that you can take something that's in demand and produce it in a time frame with good financing, you're going to do well. And so you're going to see a lot of ground up construction or lot development or things of this nature, to where we can take advantage of the macro trends, solve a problem, and make investors good money in the process.
I love it. Rob, great to have you on here as usual. We will definitely see you again, probably more than once. And thank you for spending some time with us and our listeners. Tom, any closing comments today?
Yeah, it's, always going to get Rob in here, and he's now creeping into my turf. So now we have to talk. So we'll have to talk after this.
I love it. I'm glad you guys have potential synergies there. And as always, thanks for listening. We'll talk to you next time.
Thanks, team.
Thanks.